Dollar General has seen poor financial performance in 2023 so far. The company's revenue increased by 3.9%, indicating an increase in sales, but their Q2 net income is down 31% year over year. Because of these financial facts and increasing fear in the retail industry, the stock is down a whopping 47% year to date, with the stock being down 50% from all-time highs and trading at a price that we have not seen since the pandemic. Today, we will be taking a three-step approach to thoroughly evaluate Dollar General and determine its fair value. Step 1. Margin of safety. In this step, we'll be looking at Dollar General's key metrics and ratios to determine if we should be more or less cautious when determining a fair value. Here, we'll delve into Dollar General's financial statements and assess critical metrics and ratios. In step 3, we will be using a combination of valuation models such as discounted cash flow and discounted dividend to gain insight into the value of Dollar General's business. By using these models, we can determine whether the stock is currently overvalued or undervalued in the current market based on different metrics. In conclusion, by combining the findings from the three steps, we'll ultimately determine the fair value of Dollar General as an investment opportunity. To determine the final valuation of the stock, we'll be using a margin of safety. This margin of safety will be based on the financial ratios, the financial health, and the growth of the company. We'll be using a standard margin of safety of 25% that can never go below 0%. The margin of safety can either increase or decrease based on the ratios that we're going to look at in just a moment. The severity that the margin of safety will increase or decrease by will be determined by using a scale. Where we're using 4 colors in our scale, bright red will mean a 5% increase, orange will mean no change, light green mean a 5% deduction, and bright green mean a 10% deduction from margin of safety. Where we're using 3 colors, bright red will mean a 5% increase, orange will mean no change, and bright green mean a 5% deduction. The first metrics that we'll be looking at are the margin and EBIT growth. EBIT has gone up over the years, going from $1.7 billion in 2013 to $3.3 billion in 2022, showing significant growth. This average growth rate during this period has been sitting at 8.5%, which is no change in the margin of safety on this metric. Looking at the margin has gone down over the years, going from 10% in 2013 to 9% in 2022. The average margin decline during this period then is sitting at 0.9%, which is no change in the margin of safety. Moving on to the next metrics, we'll be looking at the dividend growth and the payout ratio. The dividend increases for Dollar General have been very nice over the past years. The dividends have gone from 88 cents a share in 2015 to $2.36 a share in 2023. The average dividend growth during this period then is sitting at 13%, which is, looking at our scale, a 10% deduction from margin of safety. And this dividend is being supported by a payout ratio that is currently sitting at only 23%, which is once again a 5% deduction from a margin of safety. Moving on to the final metrics that we'll be looking at the debt to EBITDA or return on invested capital. To get our debt to EBITDA ratio, we have to take the debt of the company, subtract the cash from it, and divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of their debt. And for Dollar General, this is almost 4.5 years, in this case a 444% debt to EBITDA ratio, which is way past the red part of our scale, indicating a 5% increase in the margin of safety since our debt position is this high. The return on invested capital for Dollar General is sitting at 11%, meaning that the management is doing an alright job at allocating capital, but no change in the margin of safety on this metric though. It's looking quite okay so far for Dollar General, but let's go look at the valuation models next to determine the intrinsic value of the company. The first valuation model that we'll be using is the discounted cash flow model. I've imported the free cash flow of Dollar General going from 2013 to 2022. The average growth rate in their free cash flow annually during this period has been sitting at 3.18%, and I'm projecting their future free cash flow to grow by 8% on average for the next 10 years, because it has dropped so significantly in 2022. With this, we'll determine the future free cash flow for Dollar General and determine a terminal year of valuation, using a perpetual growth rate of 3% and a discount rate of 8.5%. This leaves us with a sum of free cash flow of $29.1 billion, and to get to our equity value, we have to add the cash and equivalents and subtract this huge debt load, leaving us with an equity value of $11.8 billion, and dividing this by the amount of shares outstanding, we get a discounted cash flow price per share of only $53.85, which is almost a 59% downside from the current price. The second model that we'll be using is the dividend discount model. I've imported the dividend payouts of Dollar General going from 4 years ago to the current year. The average growth rate in their dividends during this period has been sitting at almost 17%, and I'm projecting all of their future dividends to grow by 7%, and we'll once again be using a discount rate of 8.5% in this valuation, leaving us with a dividend discount model price per share of $168.35, which is an upside of over 29%. The next model that we'll be using is Graham's revised valuation formula. In this model, we take a look at the earnings per share that Dollar General is generating, the growth rate estimate projected by Wall Street, and the current yield of AAA corporate bonds in relation to the average yield of AAA corporate bonds that is always sitting at 4.4. And we go by the theory of Benjamin Graham that the PE of a company should never exceed 7 if the company isn't growing. And looking at all of these metrics, we get a fair value of $88.24, which is a downside of over 32%. The fourth model that we'll be using is the multiple valuation. In this model, we take a look at similar companies to Dollar General, look at their stock price and their earnings per share. This way, we can determine the average PE multiple in the industry, which in this case is sitting at 20.14. All that's left to do then to get a fair value of this model is to multiply by the earnings per share that Dollar General is generating, which is $13.35 a share, giving us a fair value of this model of $268.87, which is a upside of over 106%, meaning that it's quite a bit cheaper than its peers. And coming to our last valuation model, we'll be looking at the mean reversion theory. In the mean reversion theory, we go by the theory that a company will always trade above or below its mean. And the metrics that we use to determine this are the dividend yield and the PE ratio. In this case, I've imported the dividend yield of the past 5 years of Dollar General, and on average it has been sitting at 0.90%, while the current dividend yield is sitting at 1.81%, indicating that it's significantly undervalued on this metric. Doing the same with the PE ratio, the average PE ratio of the past 5 years has been sitting at 18.30, while the current PE ratio is sitting at only 13.35, once again indicating that it's undervalued. This gives us a fair value of $219.71 out of this model, which is an upside of almost 69%. Let's head over to the final overview of our valuation next. Looking at our final overview, we've imported discounted cash flow, discounted dividend, Graham's valuation, the multiple valuation, and the mean reversion theory price per share, giving us an average of $159.80. We've determined a margin of safety before, using a standard margin of safety of 25%, adding 5% for the debt to EBITDA, deducting by 10% for the dividend growth and 5% for the payout ratio, leaving us with a 15% margin of safety. Applying this margin of safety, we get a fair value of $135.83. And with the current price of $130.27, we get a small upside of 4.27%, indicating that's currently a buy. However, Dollar General has fallen nearly 50% from all-time highs after reporting a quarter where sales actually grew, but net income dropped significantly. Their huge debt burden makes the investment unattractive for me, even with the price having dropped by this much. If you want to get access to all of the models I use in my videos, by the way, you can check in the description for my Patreon link. And if there's any other companies that you would like to see me cover on this channel, please let me know in the comments. Thanks for watching, and I hope to see you on the next one.